Should you buy or rent your home? It's one of the biggest financial decisions of your life, and there's no one-size-fits-all answer. The right choice depends on your age, income, lifestyle, and the economic forces at play. At 25, renting looks smart. At 35, feeling like you do not own can be a mistake. What if I told you that making the wrong decision could cost you hundreds or even thousands? Today, we break it all down. We'll explore 6 powerful forces: rent inflation, supply and demand, investment potential, the time value of money, property appreciation, and the trade-off between security and mobility. In your 20s, your biggest asset isn't property, it's flexibility. Your 20s are a decade of discovery. You're entering the workforce, exploring career paths, possibly moving between cities for better opportunities, and just beginning to build savings. You stay mobile, chasing opportunity. Lower upfront cost means more money to invest in higher return assets like stocks. The question isn't, can I afford to buy? It's, should I lock myself down right now? Here's the painful reality. Rent increases with inflation. In most major cities, rent rises 4 to 7% annually on average, sometimes double that in high-demand areas. A $1,500 apartment today could cost $2,200 in just 8 years. That's money you'll never get back. Rent increases over time due to inflation and demand. You're not building equity, and you have little control over your living situation. Housing supply in most major cities hasn't kept up with demand. Young people are competing fiercely for limited rental units and driving prices up further. But that same pressure makes buying expensive too. In competitive markets, 20-somethings rarely have the 20% down payment needed to enter the market. Here's the renter's secret weapon. If you save aggressively and invest the difference, the money you would have spent on a mortgage deposit and maintenance costs, into index funds or ETFs, the returns can be powerful. Historically, global equity markets have returned around 8 to 10% annually. A $30,000 deposit invested over 10 years could grow to $77,000 or more. That's serious wealth building. The time value of money is perhaps the most powerful force in finance. Every dollar invested in your 20s has maximum compounding potential, potentially 40-plus years of growth. This is actually an argument for renting in your 20s, if it allows you to invest aggressively instead of sinking all capital into a property deposit and associated costs. Property appreciates on average 3 to 5% annually nationally, but that hides massive variation. City apartments can stagnate or fall in value, while certain suburbs boom. In your 20s, you may not yet know where you want to put down roots. Buying in the wrong location is costly. Agent fees alone eat 2 to 3% of the sale price. Renting gives you extraordinary mobility. Got a better job offer interstate, relationship change, new city calling? You can move in 30 days. Owning a property ties you down. Selling quickly in a poor market could cost you tens of thousands. In your 20s, career mobility often generates far more future wealth than any property appreciation could. The verdict for your 20s: lean toward renting with aggressive investing. Unless you are settled in a city you love, have a stable relationship, and can afford a 20+% deposit without depleting savings, renting is likely the smarter financial move in your 20s. The key is discipline. Use every dollar saved on rent to invest in diversified assets. Your biggest asset at 25 isn't property, it's time. Your 30s are the decade of transition. Many people are partnering up, starting families, and settling into careers. This is when the buy versus rent debate becomes most intense and personal. The financial landscape is shifted. You likely have more savings, a better credit history, and a clearer picture of where you want to live. By your 30s, you may have already paid $150,000 to $200,000 in rent, wealth transferred permanently to a landlord. Continuing to rent means continuing to fund someone else's mortgage, and as inflation runs at 3+% per year, your rent bill compounds relentlessly, while a fixed-rate mortgage payment stays the same. By the time you're 35, property prices in desirable areas may have risen 30 to 50% since your 20s. The window of entry is closing. Supply of family-sized homes in good school zones is perpetually constrained. Demand from your cohort, dual-income couples in their 30s, is intense. Waiting longer often means paying more. By your 30s, the investing while renting argument becomes more nuanced. Mortgage repayments in many markets are now close to or even below the rent equivalent. If you buy, you're paying principal, building equity, and interest. If you rent, you need extreme discipline to invest the surplus. Studies show most renters do not invest the difference consistently. Time value of money now cuts both ways. Every year you delay buying, property prices likely rise, meaning your required deposit grows larger, while your window to pay off the mortgage before retirement shrinks. Someone who buys at 32 pays off a 30-year mortgage at 62. Someone who waits until 42 carries debt until 72. That's a massive difference in financial security at retirement. In your 30s, buying a property in a high-demand area locks in today's price and lets you ride the appreciation wave. A $600,000 home growing at 5% annually is worth $975,000 in 10 years. Leverage amplifies this. A $120,000 deposit is leveraged on the entire property asset, and that's a return on your actual cash investment that far exceeds most asset classes. Owning a home provides a profound security, especially if you have or plan to have children. Stable schooling, community roots, and the confidence of a landlord never asking you to leave. Renting still offers mobility, and for those in volatile career paths or entrepreneurship, this remains valuable. But by your mid-30s, most people's lives have begun to stabilize geographically. Verdict for your 30s? Buying is often the wiser choice. Context is everything. If you're settled in a city, have a stable dual income, can afford a 10 to 20% deposit, and plan to stay 7+ years, buying in your 30s is statistically very likely to outperform renting. The compounding effect of property appreciation, fixed repayments against rising rents, and the family stability benefits tilt the scales strongly towards ownership. Exceptions: highly mobile careers, uncertainty about relationship stability, and extremely overpriced local markets. Your 40s are your peak earning years. Career is well established, children may be in school, and retirement is now a realistic horizon, 20 to 25 years away. Whether you've been renting or buying, this decade demands a serious strategic review of your property position. If you've been renting since your 20s, cumulative rent payments have likely exceeded $400,000 to $600,000 without a single cent of equity to show for it. Worse, rents continue to rise. At 3% annual increase, what costs $2,500 a month at 40 will cost $3,360 at 55. On a fixed retirement income, this becomes catastrophic. Meanwhile, the supply-demand dynamic shifts. You may be looking at upsizing to accommodate a growing family, or beginning to think about downsizing as children leave. Ironically, if you own property, higher prices work for you as you sit on appreciated assets. But if you don't own, higher prices make entry even more painful. The only scenario where a 40-something renter beats a buyer financially is if they've been exceptionally disciplined investors over 20 years, consistently channeling savings into equities. Research shows this is rare in practice. Most people spend the surplus rather than invest it. If you are that disciplined investor, your portfolio may rival a property owner's net worth. The time value calculation is now urgent. Buying at 40 with a 30-year mortgage means paying it off at 70, squarely in retirement. That's $2,000 plus per month of mortgage pressure on a fixed income. This is why a 15-year mortgage or a significant offset strategy is critical if you buy in your 40s. You want to be debt-free before retirement, not entering retirement underwater. Those who bought in their 20s or 30s are now sitting on extraordinary appreciation. A $400,000 home bought in 2005 is now worth $1.2 million in many American cities. In your 40s, if you haven't bought yet, you're not just buying at the top of a decades-long bull market. Mean reversion risk is real. Be careful about over-leveraging in later cycles. In your 40s, and looking ahead, security becomes paramount. Owning your home outright or close to it means no housing costs in retirement, beyond rates and maintenance. A renter in retirement faces escalating rent on a fixed income, and that's one of the greatest financial vulnerabilities of modern life. Mobility is far less valuable when you have nowhere stable to go. Verdict for your 40s? Buy if you haven't, strategically. Consolidate if you have. If you're still renting at 40, buying now, even at higher prices, is almost certainly better than facing retirement as a renter. Focus on a 15 to 20-year mortgage that can pay off before 60. If you already own, use your 40s to aggressively pay down debt, build investment diversification, and plan your equity exit strategy. The clock on debt-free home ownership is ticking. Let's bring it all together. In your 20s, lean toward renting with aggressive investing. In your 30s, there's a strong case for buying if settled and stable. In your 40s, buy now if you haven't, and eliminate debt before retirement. And remember these truths regardless of age. 1. No one consistently beats the market, whether that's property or shares. 2. Discipline is everything. Renters who don't invest the difference lose. 3. Inflation erodes a renter's position every single year.